going to be a seamless segue because my next question is the hot topic that every business owner wants. And again, I work with quite a few of them, and it's what's my business worth? And what I always find quite funny is the expectation, the practicality of where they're actually at, the difference, and then also the strategic alignment with potential buyers and why they might buy it. I know I've thrown out too many things there to answer, but on the angle of how is a company valued, I saw you present on this 2 weeks ago. So although I could salt the answer, it's better to kind of come back from you. But how is the main structure of how that's kind of worked out?
Sure. So you've asked a number of questions, Steve, as you said, and if we had a good few hours, I'd be delighted to deliver a seminar on business valuations. However,
just a 6-minute answer would be brilliant.
a super quick, albeit accurate, considered response. So depending on the sector in which the business sits will dictate the valuation methodology, Steve, that should be used. So if I can give you one or two quick examples. So if it is a business that sells software as a service, that business will typically be valued at a multiple of revenue, typically 3 to 5 times revenue, depending on what the business does, its scale, and I guess how long a typical contract will span for.
That's revenue, not net profit.
Correct. For a business that provides services through software, so a SaaS business, a technology business, because that business has recurring revenue, Steve. Therefore, a buyer is willing to value a business based on a multiple of that recurring revenue line. Another example, quite depressingly, is funeral care homes. So typically, the likes of Dignity and the Co-op, who are the two most active consolidators in funeral care, when they value an independent funeral care home, they will value those businesses based upon a pound note multiple of the number of funerals typically delivered per annum. So, those examples certainly, hopefully explain that there are nuances. However, a typical privately owned business, let's call it an engineering business or a manufacturing business that don't have contracted or recurring revenues, typically that type of business will be valued using an earnings-based valuation methodology, Steve. And that effectively simply involves us having to establish a business's maintainable profits, and we multiply the maintainable profits by an earnings multiple, which would give us the enterprise value of a business. So as an example, if a business delivers maintainable profits of £1 million, and the view is that because of the size of the business, because of the client reliance within the business, because maybe there's 1 or 2 chunky clients in there, Steve, that are important, maybe there is a limited degree of succession in place, the view might be the multiple should be 4 times. So 4 times maintainable profits of £1 million would give us an enterprise value of 4 million, Steve. But of course, that's typically where the man in the pub would stop. He'd say, well, that means your business is worth 4 million, right? Well, no, because of course that doesn't take into consideration the balance sheet of the business, Steve. So the other adjustments that need to be considered to arrive at the equity value, which is the value of shares, is to add to the enterprise value an amount equal to cash. So any cash on your balance sheet, which is accumulated under your ownership, is for your account. So should be added to the enterprise value. The second adjustment, Steve, is for debt. So to the extent there's any debt on the balance sheet, of course, the buyer will inherit that debt because the buyer is acquiring the shares and therefore takes with it any liabilities that sit on the balance sheet. So the debt would come off. And debt would typically involve bank loans, overdrafts, hire purchase, corporation tax liabilities, Steve, etc. And then finally, there'll be an adjustment for normalization of working capital, to make sure the business assumes it has a normal level of working capital to trade wholesale of the business. So once you take into account those 3 buckets of adjustments, you get, Steve, to your shareholder value or your equity value.
Because one of the things which I think is just worth kind of drilling home is the fact that all of the factors which can affect a multiple, and you can actually influence and positively change over time to really take a business that some people might value at 4 to many times that They're actually changing different things. So we won't go into it now. We'll save that for another day because I'm very conscious of your time. But the point is, there are lots of things that you can do to really help grow and drive your business. And the earlier that you start and engage with people and advisors, effectively, the more money you can make as you kind of go on that journey.
That's a great summary, Stephen. You're right. And if you think through what I've just set out there in terms of how a business is valued, the reality is, the owner of a business with the right advice can proactively influence not only the adjusted or maintainable earnings of a business, but they can also influence the multiple that they will achieve on sale of their business. They can manage and therefore influence the level of cash in the business by, for instance, collecting debtors sooner by improving credit control. And they can also reduce the level of cash tie-up in working capital. Mm-hmm. So actually, shareholders, if they engage early with the right corporate finance advisors, can really move the needle when it comes to the value they will see on sale of their business.